Thank you, ladies and gentlemen, for joining us this morning or this afternoon, wherever we find you. I'm delighted to be joined on the call by Jonathan Gordon, who is in the UK. Where are you, Johnny? Devon somewhere?
I'm in sunny Bath, where it's currently -6.
Snowy, sunny Bath. Very nice. Well, look, very good. I've joined in from Qatar. Been watching, unfortunately not watching England, but I watched a wonderful bit of football. But I mentioned that because I've had a few connection issues with my Wi-Fi. So just in case I disappear, I do seem to be able to rejoin in fairly quickly. So today we're going to be discussing some of the questions that we've had from a recent email campaign that we put out to our client base, just to sort of see what people want to discuss. So it's going to be a fairly informal session, probably take us about 20 minutes, and then we'll have some more Q&A as they come in as well, which we do expect throughout the session. So we will begin, please. Next slide, please, Nicola. Right, very quickly, just 2 or 3 minutes on IP Global, given we may well have a few people that don't know our business. In terms of what we do, it's vast. We reach many different countries. We've been in the property game since 2005, when the business was first set up by our current chairman, who's still very heavily involved. And our whole background is based on research, transparency, and delivering on what we promise. So I'll cover a little bit more on that. To date, we've invested in 15 international cities all over the world. These days, we're a little bit more focused on low risk markets for obvious reasons. So heavily focused on the UK, do more and more in Germany, and do a little bit in Portugal. Will we do other markets? Potentially, yes, when there's opportunity and when the time is right. We've been looking at cities like Madrid in Spain, but there are a few things that we always need the sort of recipe book. So, that does restrict us a little bit about where we want to go and what we want to do. Next slide, please. Right then, so without further ado, we've literally, the format is questions. So we're going to bring up some of the questions that came in. So these are real questions that came in from our client base, and then we'll obviously take questions as well at the back end. So let's throw Johnny that first question. How will increasing costs of living, and in particular energy prices, have an impact on the housing market? Something we've been asked a lot about, actually, probably in every meeting I've done in the last sort of 4 or 5 months is, and this is the sort of thing that people want to know, and we need to have the data to back up what we think.
Yeah, good morning everyone, or afternoon wherever you are. I think cost of living and energy prices are all in sort of a bundle of things that I think are running against house prices at the moment. I mean, you've also got interest rates as well, which we'll talk about later, but ultimately this comes down to affordability. This comes down to, the proportion of people's wages that they're spending on just living, eating, heating houses, etc. And then, the point there is, well, what do they have left over to pay for either rent or mortgages? And it is tight in the UK at the moment. I mean, it is a tricky time. Inflation, I think, peaked last month at 10.1%. It's actually come off a bit now. I was reading that the last figures I noted down this morning, actually it was 11.1% last month and 10.7% end of November. So, has inflation peaked? That's the question. We'll see, I guess, during sort of Q1 next year. But there's no doubt that things are calming down here in terms of house price growth. I mean, we have double-digit growth during the sort of years of COVID, 2020 and 2021. And then midway through this year, after the mini budget that we had a few weeks ago in the last government, interest rates went up. And then things pretty much ground to a halt in the housing market in terms of prices. I think while people sort of absorb the news of an uplift in interest rates, and also factoring in these cost of living and energy price hikes that have gone up. So look, my point here is that I do think things are slowing down for sure. I think some markets, it's a very segmented market here in the UK, and some markets are slowing down much more than others. I mean, we were talking yesterday about the sort of secondary market here, or secondary market as far as sort of holiday resort type properties concerned in the sort of southwest and parts of the east coast of the UK. No doubt those transaction levels have halved, even more so over the last sort of few months. And on an average basis across the UK, that's all dragged prices down, or the average prices down. But it's important to note to see what's actually happening in many of the larger cities, the Birminghams, the Manchesters, the Londons, for example. London is forecasted to come off anything between 1% and 5% next year on average, where I think places like Manchester and Birmingham are pretty much due to sort of flatten out and stay as they are. So I think the overall message is, depending on where you are, this is having more or less of an effect on house prices, in some places more than others. Will, have you got anything to add on that?
No, I think you're right. So I think your summary is a really long, good answer, but it's complicated as it always is. But it's the UK segmented. Areas that saw a lot of growth have stagnated and potentially dropped. Areas that saw less growth will probably be less impacted by this. But I think there's no ignoring that the market has slowed a little bit. I don't think we're overly concerned. It's sort of answering another question, probably. Yeah, this is the question it leads on to. These are genuine questions, but we put them in a logical order, right? But what is this? We talked about energy prices, but that leads into a recession effectively, right? Because less money is spent in other sectors. Okay, so we've got effectively a little bit of a recession going on. Most people predict it to be fairly short and fairly hard, and I think that's probably what government and central banks want. But ultimately, you've got a big lack of supply in the UK. You've got rising build costs. We've had a lot less supply in the market over the last 2 or 3 years, and that's evident when we go and buy a scheme, how quickly we sell it, even during times when the economy hasn't been as strong as perhaps it was in sort of 2014, 15, 16, where we would sell a project out in a few days, right? But there was a lot more product around then. So you've got less supply. You've got rising costs, but those are the things that I think will stop the UK market correcting, and especially those areas that haven't seen that sort of significant growth over the last sort of couple of years.
Yeah, I think, look, the question there is how much to expect the UK to correct with the impact of a recession. The general numbers that I'm seeing on average are a contraction in prices, anything between 6 and 10% on average over the next year. But look, that's an average. I was reading an article yesterday that some of the most affected markets, similar to my point earlier, were the areas where people were buying second homes during COVID because they couldn't go on holiday anywhere else. So places like the Cotswolds, Stroud, parts of Norfolk, the Southwest around Cornwall. I mean, those prices went up, 30, 40, 50% in some situations, where the average price of the rest of the market went up by 10 to 20% over the last 2 years. So they were massively out of kilter. And obviously that had to stop at some stage. And now travel is more easy. I say more easy. It's certainly not easy in some situations, but it's easier for people to travel away. So therefore, the sort of appetite for secondary homes in the UK has diminished somewhat. And that's all helped sort of bring that average down. So to answer that question, the average that we're seeing is something between 5 and 10%. But again, it comes back to this segmentation of the market. Next year, London is due to come off anything between 0 and 5%. But I mean, mostly, I think the majority of these markets are just going to tread water for sort of 12 months or so. And I think that's what investors have to expect. 2020, 2021, you're expecting double-digit growth every year. And that needed to stop, needed to come down, and it has. As I say, it came to a fairly abrupt halt about 6 months ago. But I think investors just need to manage their own expectations and just be smart about where they're investing and keep more of an eye on the rental market, because it's ultimately the cash flow that's the most important thing probably over the next sort of 12, 24 months as interest rates start to come down. One thing I noticed as well, I was reading that, these statistics pretty much state globally, certainly within the UK, that we're not building enough houses. There was a article written by Professor at Heriot-Watt University, said England needed 145,000 affordable homes every year. Last year we had, I wrote it down this morning, 59,175. So the overall trend is behind. It's constantly playing catch up. And I do think that's one of the reasons why this lack of supply will keep the market propped up in what is a very, very tricky economic environment at the moment.
Very good. Leading on to the next question, interest rates. I think this is a really good question, but I think you can't expect a magician to appear out of nowhere for you here, because, you know, we can't do a lot about this, but effectively, and I've been speaking to very small brokers about this, and also sort of personal situation, just need to ride it out, I think, is ultimately what I will do. And I think what we're talking to clients about, because we don't see this being a long-term issue. We think it will come back. It already has come back about 1% from when the lenders were sort of not sure where to price products. Effectively, that sort of peak, we've seen them come down about 1%. But ultimately, you wouldn't go and look for a fix now. You'd probably be taking a variable. If you're coming off of your variable, your fix, you'll be going onto a variable, and you won't want to fix at the new rates ultimately, probably. So really, I think it's just about riding it out, being careful with your cash flow, and ultimately, long term, we do not see the UK being a high interest rate environment, but we certainly do see it being higher than where it was. Just to sort of lead on a little bit.
It's interesting to see. It's normally the sort of financial markets, the derivative markets, that tend to give the most accurate predictions, and you know, those markets are now predicting topping out at 4.5% in the UK, 5% in the US, and about 3% in Europe. So already, certainly as far as the UK is concerned, that's come down significantly over the last 3-4 weeks, as the sort of perceived risk in the market has come off. So there was even suggestion to say that going forward, you might even be able to fix in an interest rate lower than the current base rate within the UK, which will be a first. But it just shows that these markets are notoriously difficult to predict. But I think the overall message is that it's looking a little bit more positive than it was, you know, 2 to 3 months ago.
Yeah, maybe a first in our lifetimes, Johnny, because we're very young. But yeah, certainly the first time I've seen it ever been potentially discussed that it could happen. I didn't know it could happen, actually. But look, we'll come on to answer that question a little bit more. Is really about rents, but we've probably got our order of questions slightly wrong. But we'll come to rents as well, because there's some positive news on that front, which is helping a lot of people when it comes to servicing their debt. Johnny, foreign investors I think the word is probably sort of international investors, isn't it? It's probably a better way of putting it, but good question.
Well, I think there are. I mean, I noticed, you know, sterling US today is 123, and about 6 weeks ago it was 103. So, you know, sterling has appreciated significantly in relative terms over the last 6 weeks, but still there's value. I mean, any US dollar denominated currencies or peg currencies into the UK at the moment are getting significant discounts to where they were getting, you know, 5-10 years ago, for sure. And if we look at, you know, relative interest rates here in the UK compared to where they are in overseas markets, they're still probably a little bit better than, certainly as far as the US is concerned, borrowing US dollars in the US and other parts of Asia. So Asia / US into the UK, for sure there are opportunities now. And you know, in terms of looking at the demographics of people who are looking at the US, looking at the UK now, there's certainly more US buyers than there has been in many years. I mean, 10-15 years, according to sort of local agents in the UK. Yes, in the UK. So clearly opportunities are there. Will sterling stay where it's at for the time being? Probably yes. But in overall terms, in the sort of long-term running average, you know, Hong Kong dollar, for example, it's around 10 to sterling. I mean, I remember when it was up to 15, 16 in 2005, 2006, that was probably too weak. But I think the overall running average of around 12 to 1 still shows that sterling has got some upside, certainly in Hong Kong dollar / US dollar terms. I think euro less so, but still the purchasing costs for overseas investors buying into the UK are certainly far less than in many of the markets that we're looking at. So I think there's still value there.
Yeah, exactly. And look, as you see a little bit of a slowdown in the market. A company like ours, I mean, we didn't really touch on it much, but we're a buyer because ultimately we forward purchase developments. We commit to buying developments from developers. So when we see a little bit of uncertainty, developers start ringing us a little bit more. They start wanting to talk to us about various schemes. So, we don't see, panic, but we do see the interest to actually de-risk and look to exit a little bit. And we can carefully take advantage of some of those opportunities. But at the same time, we don't want to get into bed with a developer that can't deliver a project and is tight for cash flow. So it's about just being selective, and we're probably going to be able to be more selective than we've ever been in the next 12 months in terms of what we bring to market, because we will keep buying, because we are an investment company and we look for opportunity. And if you're not investing, you can't make money. And if you've got inflationary environment, you can't sit still. So, we certainly won't sit still ourselves. Another, just coming back to that question, just leaded on to another thought of mine that I was speaking to a client recently, and he's having a bit of a moan about interest rates, as we all like to do, and that's fine. But I said, well, hang on a minute, you're getting your dirhams. Effectively, he's based in the UAE, in Dubai. You're getting your dirhams buying you more pounds. So ultimately, you can actually borrow £20,000 less than we originally calculated. Therefore, you're going to suffer less from interest rate environment. And you're going to get more equity in your property. So it's kind of like, you can't have your cake and eat it. You can't have the pound on its knees and expect interest rates to be rock bottom. There was a moment where that was possible, and people that were brave enough took advantage of that. In fact, I had people buying from me just in COVID when we were locked in our houses, and they've done very well. But ultimately, not all of us are brave enough to take those decisions at those moments. So can't always take advantage of those things. Rents. Will rents continue to rise? Well, let's start off with how much have rents risen. I mean, here's some really interesting data from Savills. So 2022, the London market saw 14% average rental growth. Okay, I'd like to caveat that by saying that for the last 3 or 4 years in London, there's actually been very little rental growth. Okay, so we haven't just seen a sudden boom out of nothing. We've seen stagnant years because of the challenges of, probably in reality, a sort of messy Brexit stopped London really doing much during that time. And then we've had COVID, which sort of did, of course, impact the ability to increase rents as businesses weren't operating and people didn't you couldn't increase rents during that time. Now, Savills predict from 2022 up to 2026, their prediction was 31.9. So, we're already halfway towards where they think rents will go. We think this is very sustainable because it hasn't grown much in the last 4 years. We think this is very sustainable and very achievable. And this is going to go a big way towards obviously helping those that are suffering with slightly higher interest rates in the short term. Looking at the wider UK, Johnny's talked about this sort of segmentation, and it is a bit of an average number. It needs to be looked at more carefully, but it's useful. So you're looking at 2022 average UK, not including London, was 9% growth. And Savills' prediction for 2022 to 2026 is 26.1. So again, these are very sensible, achievable numbers out of London. And this is a big part of what we're seeing moving forward. We've got too many. I mean, at the moment, Johnny, you read an article recently you sent to me, which was a tenant saying, what did it say? Can you remind me?
He was saying that, again, this was in London. This was an interview with a local London agent. He basically had to give a sort of short CV, a short summary of what he does for work, references, and offer to pay either 12 or 24 months up front, which, is a sort of headline making article, obviously, but you just wouldn't have seen that 2-3 years ago. And I think it's sort of fairly symptomatic of where the market's at, isn't it? That people are scrabbling for property. I mean, the interesting reason behind this is, why is this? Why is this sort of suddenly happening now? We get asked this quite a lot, and I think there's a few reasons. One, the overall rental stock has come off just because investors have sold to take profits because property prices have gone up so much over the last sort of 2-3 years. So that's taken out a segment of the market. Two, and I think this is sort of less relevant now, but certainly earlier on this year, some tenants were able to lock in, extended periods of rent during COVID because they felt that they had a sort of strong negotiating period and try to fix their rents for sort of 2-3 years. And again, that took a chunk out of the market. And three, just that overall supply demand deficit that I was talking about earlier. I mean, we as a business are finding it very difficult to find new stock coming through, just because the whole planning system is so painfully slow here in the UK. So that new stock that needs to be coming through of affordable property is just not coming through. So combined, it's just really sort of squeezing the market. So, and I think over the last sort of 3-4 months, with interest rates rising, people are thinking again about buying. So therefore, that's another additional chunk of people that are chasing rental stock in a already very, very crowded market. So it's the perfect storm at the moment for the rental market. I don't think they'll carry on going on their same trajectory as Will was saying earlier on. I mean, they've gone up so much this year. I think landlords have to be sort of mindful of people's affordability. Certainly in Scotland, there are certain areas that have got rent controls to combat this. I don't think we'll have it in the UK. But yeah, I think it's a good time to be a landlord just now if you're, if you're looking at your cash flow, because you're in a very strong position. But I think you need to be reasonable as well and not price tenants out of the market.
Yeah, I mean, look, we manage around about 1,600 units in the UK, a majority in London, about 650 in Birmingham, and a good balance of the rest in Manchester. And we've been seeing this data here that I've read out. It's no surprise. I mean, it's been evident. It's been in black and white on our sort of emails that we update our staff on in terms of all of our colleagues. So it's real. But you want a good tenant. You want to look at, if you've got a good tenant that pays the rent, you need to just be a little bit careful and not just charge in and think long term. But there is rental growth. Right, what have we got next question? So the answer to that question is yes, but it's sustainable, but it might slow a little bit. We could have just said that at the very beginning. Right, what have we got next? Defaulting on their rents. I mean, I don't think I prepared for that question too much. Well, if they do, we'll just get a new tenant in because we've got lots of them. But I think reference your tenants. You can pick who you want to rent the property to. Someone knocking at my hotel door. Johnny,
I think also it depends on the market sector as well, and what you're renting and where. I think that unfortunately some tenants will struggle in certain parts of the market. But as an investor-led business, what we've always looked at is the sort of medium to higher end of the market, where potentially there's a little bit more protection against that. Tenants will be earning more. They'll be carefully referenced by us. So the chances of default are lower, but it's not impossible for sure. And it's an unfortunate situation for everyone when that happens. But again, it's back to that point that I made now. I mean, landlords just have to manage their own expectations and not be greedy. And I think, our lettings team will help manage that as well.
Yeah, I mean, we do. Yeah, I mean, we had a challenging environment during COVID with rents. Tenants were sort of told they could stay and they disappeared off, and they sort of reappear a few months later going, oh, I owe you some money. So we had to manage a little bit of that, but that managing that carefully is very important. So you need to make sure your letting agent is, because that's ultimately what you pay them to do. It's not just collect the rental each month when it's very easy. It's actually when it's more challenging that it becomes an issue, and that's what you need and deserve from your rental company, because the easy ones are not always I don't know what I'm trying to say there, but I think you understand me. Right, what have we got here? Will the government ever get round to helping flat owners extend their leases? Well, I did my dissertation on this subject for my APC and everything. Well, there is a lot of protection around this. So you do have a right to a new lease. I think you have to live in it for 2 years, or you have to own it for 2 years, but you do have a right to a new lease, and your right is actually to extend it by the original term on top of the balance of the lease. So if you took a 250-year lease, for example, and you were 50 years in, you have a right to a new lease of what's left plus 250 at a peppercorn ground rent. Now, that is subject to a payment, like a premium, which is calculated based on a sort of marriage value. But the earlier you do it, the better. So, you're talking a few £1,000s in most cases when you have a significant time left on your lease. Probably getting.
I think the point here is that ideally you don't want to get involved in any of this. I mean, whatever you're buying for an investment should be a minimum of 125 year lease, and then you're not going to get into an issue. I mean, most of the stuff that we're doing is 250 plus, which effectively is the same as a freehold. I mean, it's always very tricky explaining to foreign investors this strange system we have in the UK of leasehold, freehold, but ultimately a long lease is pretty much the same as a freehold, and you're not going to be restricted in any ways, and banks aren't going to sort of look at it, we'll look at it the same as anything else, but anything less than 100 years, banks will tend to look at it a little bit more closely, I think.
That's correct, yeah. What was that final question? Are there commercial benefits to investing in? Well, I mean, we do seem to be coming out the back of COVID-19 or COVID-20 or COVID-21, whatever COVID is. So, we're seeing sort of the news coming out of China now about unlocking. I think that's going to help the wider world. If that continues on that trajectory, we'll have to see. So I think we sort of tread carefully still, don't we, as a slightly different collection of humans than we were before COVID-19. But inflation is coming because the world is kind of booming in some areas, right? And there's not enough supply. So I think what we need to do is sort of get through these challenges. Johnny, have you got anything meaningful to add to that question?
Well, I think in terms of the commercial market, we're seeing already that working practices have changed. There was that knee-jerk reaction at the beginning of COVID that city living was dead and no one was ever going to work in an office, and no one wanted to, and everyone was quite happy on Zoom and Teams. And then after sort of 3 or 4 months of some of the world going a little bit insane working at home, it kind of went the other way, that actually people did want to go to work. They missed the social interaction and all the benefits that come with that, and therefore offices were needed. But I think this hybrid working is pretty much here to stay. So commercial properties the commercial market has changed. I mean, no longer do some of these larger corporates require these sort of huge premises, and the market has behaved accordingly. So the whole flexible living, flexible working needs to be reflected within the sort of commercial buildings that you're looking at. But I think that market has come back, but probably not as strongly as some of the residential market has. I mean, the investor market is still not sure how the commercial world, commercial buildings is going to end up. So whilst the sort of grade A is always in demand, if you look at the B's and C's in terms of how it's graded, that market is probably much softer than it was maybe 5 years ago. So we just need to see how that's all going to end up. I've got a question here. What's your opinion and comment on the US and UK house market? US house market is already falling so fast. I think my reply to that would be, well, it's an issue with supply. I mean, there's a lot more supply in relative terms in places like the US, places like China, than here in the UK and other parts of Europe. And no question, as we've talked about pretty much consistently through this, I mean, it's a tricky economic time for most people, and the house market is and has suffered and will continue to do so probably for certainly the short term, and markets specifically where there's too much supply are the ones that are going to fall the fastest and probably for the longest. So I think that's probably one of the key reasons why the US has come off more quickly than the UK market.
Yes.
Any other questions? We've got a note from Gary. I just want to say hi and thanks for your webinars in 2022. Happy Christmas. Well, thank you, Gary.
Going back to good. Well, look, we've covered most of the topical things. I think I'm losing my internet connection now. No, I'm still in. And we've taken, 30 minutes? Well, look, if there's no more questions, we obviously got all the questions in during the email campaign, which was really good. We had a lot, and effectively they were all around, what are we talking about? 4 or 5 sort of key points here, right?
Yeah, I think, what rents are doing in the sort of short, medium term, and I think that curve is coming off of increase, but I still think the overall trend is upwards, as we discussed. Interest rates look as if they're flattening out next year, certainly peaking in the UK about 4.5%, according to the finance markets. Still a massive issue with supply demand, 145,000 affordable properties, and that word affordable is important because these are what normal people and normal salaries can afford to live in, and that's the market that we're sort of primarily focused on, and not enough properties are being built. But I think overall investors need to manage their expectations that capital values aren't going to go anywhere probably for the next sort of 12 months or so. But interestingly, from our end, as Will said, we are buyers. We do underwrite projects, and it's so difficult to find projects in the right area at the right prices. I mean, that would suggest that the market is a little bit more stable in some of these markets, and clearly those are the markets that we and you as investors want to be present in. Are you still there, Will? I think we might have lost Will. So look, why don't we wrap up there? Thank you all for joining today. If there's any more questions, please let us know. Please email us any more questions that you might have, and we'll do our best to get back to you. But thank you very much indeed for listening today, and look forward to presenting to you again soon. Thanks very much.